Stop looking for a better trend strategy. Start looking at why you can't follow the one you have. I've never met a trader who failed because their moving averages were wrong. I've met thousands who failed because they couldn't tolerate sitting in a winning position while it pulled back, couldn't handle being early, couldn't resist taking profits too soon. The only trend strategy you'll ever need isn't a strategy. It's the ability to execute the simplest strategy without your emotions destroying it. And I know exactly where you are right now. You've tried multiple trend systems. Maybe you started with moving average crossovers. Then you tried breakout strategies. Then momentum indicators. Maybe you layered them together thinking more complexity equals better results. And each one made sense. Each one worked in your back tests. Each one had logical reasons why it should capture trends. But when you traded them live with real money, something happened. You couldn't follow them. You'd exit winners too early because you were scared the profit would disappear. You'd hold losers too long hoping they'd turn around. You'd override the system at exactly the wrong moments, telling yourself this time is different. This situation requires discretion. And this pattern, this cycle of knowing what to do but not doing it, it's not just costing you money. It's destroying your confidence. It's making you question whether you're cut out for this, whether trading is even possible for someone like you. Because if you can't follow a simple strategy, what hope do you have? This video isn't about giving you another trend strategy to add to your collection. It's not about showing you some proprietary indicator or secret system that finally works. It's about showing you why all your strategies keep failing you and what you actually need to do about it. Because the core pain, the thing I know you're experiencing every single time you look at a chart that trended without you, is this disconnect between knowing and doing. You know you should let winners run, but you can't do it. You know you should cut losers quickly, but you hesitate. You know you should follow your system, but you override it constantly, and that gap between knowledge and execution, that's what's keeping you stuck. Not lack of information, not lack of strategy, lack of psychological capacity to execute what you already know. Here's the unique insight that changes everything, the perspective that stands completely apart from what every trading course and guru is selling you. The only trend strategy you need is one simple enough that you can't hide behind complexity when you fail. Because complexity gives you excuses. You can blame the indicator, the parameter settings, the time frame, the market conditions. But simplicity exposes you. There's nowhere to hide. Just you, the trend, and whether you can follow it. And the real work, the work that actually determines whether you succeed or fail in trading, isn't finding that perfect strategy. It's developing the psychological capacity to execute a simple strategy without sabotaging yourself. The strategy is just a vehicle, a tool, a framework, but you're the one who has to drive it. And if the driver keeps crashing, getting a fancier car doesn't help. You need to become a better driver. So what you're going to take away from this video is yes, one simple, proven trend strategy. I'm going to give you that. But more importantly, you're going to get the psychological framework to actually follow it, to stay in winners even when they pull back, to cut losers even when you hope they'll recover, to execute the system without your emotions constantly overriding your logic. Now let me tell you a story that makes this completely clear. There's an old story about a master carpenter who built the most beautiful furniture in his village. People would travel from distant towns just to commission his work. Tables that became family heirlooms, chairs that lasted generations. His craftsmanship was legendary, and everyone assumed he had a workshop full of exotic tools, specialized equipment from distant lands, trade secrets passed down through generations that gave him some unfair advantage. One day, a young apprentice, eager to learn the master's secrets, asked if he could see his tools. He was expecting to see a room full of equipment, advanced machinery, things he'd never heard of. The master smiled and opened a simple wooden box. Inside were basic tools, a hammer, a saw, a chisel, a measuring square, tools that anyone could buy at any market, tools that the apprentice himself owned. The apprentice was genuinely confused. He looked at the master and said, "But master, how do you create such masterpieces with such simple tools? Where are your secrets? Where's the special equipment everyone talks about?" The carpenter sat down and said something the apprentice never forgot. He said, "The tools are never the secret. I've seen craftsmen with workshops full of the most expensive equipment who can't build a simple chair that doesn't wobble." The secret isn't in the tools, it's in three things. First, knowing exactly what you're trying to build before you pick up a single tool. Second, choosing the right tool for that specific job. And third, using that tool with complete commitment. No second guessing. No switching tools mid-cut because you think maybe a different saw would be better. Just clarity about the goal, choice of the appropriate tool, and total commitment to seeing the cut through without interference. And then he said something that hit even harder. He said most people collect tools thinking that's the path to mastery. They fill their workshops with equipment. But they're like musicians who own every instrument but can't play a single song beautifully. They switch from hammer to saw to chisel without ever completing a single piece. They're always looking for a better tool instead of learning to use the one in their hand with complete mastery. Most traders are exactly like those tool collectors. They have workshops full of strategies, indicators, systems. They've tried moving averages and MACD and RSI and Bollinger Bands and Ichimoku and a dozen other things. They own every tool, but they master none. They're constantly switching strategies mid-trade because maybe this other approach would be better. They never commit to one simple system long enough to develop true mastery of execution. But here's what that story doesn't tell you. Here's the part the carpenter didn't explain to the apprentice. What stops someone from committing to one tool? What makes them keep switching? It's not that they don't understand the value of commitment intellectually. It's that commitment requires tolerating discomfort. When you commit to one tool, one strategy, you can't blame the tool when things go wrong. You have to face that maybe you're using it incorrectly, maybe you lack skill, maybe you need more practice, and that's uncomfortable. It's much easier to switch tools and blame the previous one than to stay with one tool and face your own limitations. Let me give you another image. Watch a river flowing down a mountain. I want you to really visualize this. The river starts high up in the mountains, and it has one direction, one commitment, downward toward the ocean. That's its path. That's its purpose. And as it flows down the mountain, it encounters obstacles. Big rocks, fallen trees, cliff faces, changes in terrain, but the river doesn't stop flowing. It doesn't question its direction every 5 feet. It doesn't wonder if maybe flowing east would be better than flowing west. It just flows around the rock, over the fallen tree, down the cliff in a waterfall. It adapts to every obstacle while maintaining complete directional integrity. But here's what's important. The river isn't rigid. It's not trying to force a straight line. It's not demanding that the mountain conform to its preferred path. It flows with complete flexibility around obstacles. Sometimes it goes northeast for a mile before turning back south. Sometimes it splits into multiple streams that rejoin later. Sometimes it slows down in a wide pool before accelerating through a narrow channel, total flexibility in path, but absolute commitment to direction. That's the paradox of successful trend trading. You need absolute commitment to direction combined with complete flexibility in path. Most traders do the exact opposite. They're flexible about direction, switching from bullish to bearish based on every news headline, every pullback, every piece of noise. But they're rigid about path. They demand that price move in a perfectly straight line exactly as they predicted, or they exit the trade. The river doesn't quit flowing downward because it encountered a rock. But traders quit trending trades because price encountered normal resistance. The river doesn't switch directions and start flowing uphill because one section had to flow northeast for a bit before continuing south. But traders exit long-term uptrends because of 1 week of sideways consolidation or a pullback that temporarily went against them. The river has directional commitment with path flexibility. Traders have directional flexibility with path rigidity. And that inversion, that backward relationship with commitment and flexibility, destroys trend trading. It makes it impossible to capture big moves. Because big moves never go in straight lines. They always encounter obstacles. They always pull back. They always test your commitment. And if you're rigid about path while being flexible about direction, you'll exit every time the path gets uncomfortable. So what does directional commitment with path flexibility actually look like in a real trading strategy? Let me give you the only trend strategy you'll ever need. And I mean that. This isn't hyperbole. This is the system that if you executed it consistently for 100 trades, you would be profitable. Not because it's magic, but because it works, and it's simple enough that you can't hide behind complexity when you mess it up. Here's the entire strategy. On your charts, you put two exponential moving averages, a 50-period EMA and a 200-period EMA. When the 50 crosses above the 200, you are in an uptrend. You only look for long positions. You are directionally committed to upward movement. When the 50 crosses below the 200, you're in a downtrend. You only look for short positions or you stay in cash. That's your trend filter. That's your directional commitment. For entries, you wait for price to pull back to the 50 EMA during an established uptrend. When price touches or gets close to that moving average, that's your entry signal. You enter long. Your stop loss goes just below the most recent swing low. And your exit is one of two things. Either price hits a predetermined resistance level where you take profit, or price closes below the 50 EMA, which signals the trend might be over. When that happens, you exit. That's it. That's the entire system. This isn't new. This isn't proprietary. This isn't some secret I discovered. This is basically what every successful trend trader has used in some form for decades. Richard Dennis taught something similar to the turtle traders. Jesse Livermore talked about following the trend. Ed Seykota built his fortune on trend following. The specific parameters might differ slightly, but the core concept is identical. Identify the trend direction, enter on pullbacks, stay in until the trend shows signs of ending. And here's what's important. This strategy works. Not every single trade, but across 100 trades, across a year of execution, it captures trends and cuts losses. The mathematical expectancy is positive. It wins less than 50% of the time, but the winners are much bigger than the losers. That's how trend trading works. That's how it's always worked. So if the strategy works, if it's been proven over decades by multiple successful traders, why doesn't it work for most people who try it? And this is the critical question. This is where we get to the real issue. It doesn't work because they can't tolerate what following it requires. They can't tolerate being early sometimes and sitting through drawdown while waiting for the trend to develop. They can't tolerate being in positions that go sideways for weeks with no movement. They can't tolerate watching small profits turn into small losses when price whipsaws around the moving average. They can't tolerate exiting a position at the 50 EMA only to watch it reverse and continue trending without them. All of those things, all of those uncomfortable experiences are part of executing the strategy correctly. They're not bugs, they're features. They're the price you pay for capturing the big trends that make all the discomfort worthwhile. But most traders can't pay that price psychologically. So they abandon the strategy, not because it failed them, but because they failed to execute it. Let me break down the 3 specific psychological barriers that destroy trend traders. 3 moments where people abandon their strategy. And I want you to see if you recognize yourself in any of these. Barrier number 1 is what I call the early entry problem. You follow your system. Price pulls back to the 50 EMA in an uptrend. You enter. And immediately, within hours or days, price continues to drop. It goes below the 50 EMA temporarily. It approaches your stop loss. You're sitting there watching a position that's underwater, that's losing money, and you feel stupid. You feel like you were too early, like you should have waited for more confirmation. So what do you do next time? Next time, you wait. You wait for price to actually bounce off the 50 EMA and start moving back up before you enter. You want confirmation. You want to see that the pullback is over, and you know what happens? You enter late. You pay a worse price. And when price pulls back again, which it will because that's what trending markets do, you're at break-even or in a small loss instead of being in profit. The barrier here is that you can't tolerate being early, even though early entries are how you get the best prices. Even though being early is part of the strategy. Your emotional need to feel right immediately, to have the market validate your decision right away, makes you override the system. You add a confirmation step that wasn't part of the strategy, and that modification kills your edge. Barrier number 2 is what I call the profit erosion problem. You're in a winning position. You entered at $50. The stock runs to 58. You're up 16%. You're feeling great. And then a pullback happens. Normal, healthy pullback in an uptrend. Price comes back down to 54. Now you're only up 8%. Half of your profit disappeared. And your brain is screaming at you. It's saying, take it. Take the 8% before it becomes 4%. Take it before it becomes a loss. Lock in the profit while you can. But your strategy says, hold. Hold until price closes below the 50 EMA or hits your predetermined target. The strategy says, this pullback is normal. This is how trends work. But you can't tolerate watching your open profit decrease. You can't stand the idea that you had 16% and now you only have 8, and it might go to 4 or 0. So you override the system. You exit at 8%, feeling smart that you locked in profit, and then you watch the trend continue to $90. A 60% move that you captured 8% of because you couldn't tolerate the temporary discomfort of profit erosion. The barrier here is that you can't tolerate open profit decreasing, even though that's how trending works. Trends don't go straight up. They move in waves. And if you exit every time a wave pulls back, you'll never ride the full trend. You'll collect small profits while missing the big moves that make trend trading worthwhile. Barrier number 3 is what I call the boredom problem. You're in a position. You entered 3 weeks ago. It's been sideways ever since. Price is just bouncing between 52 and 54. Nothing's happening. And meanwhile, you're seeing other stocks breaking out. You're seeing momentum, plays running. There's action happening in other parts of the market, and you're sitting in this dead position doing nothing. Your strategy says hold. The 50 EMA hasn't been violated. The trend is still intact. You're supposed to be patient, but you can't stand it. You can't tolerate the inaction. The opportunity cost feels unbearable. So you exit your trending position to chase the breakout that's happening right now. And what happens? Your original position finally breaks out of its consolidation and trends without you. And the breakout you chased reverses and stops you out for a loss. The barrier here is that you can't tolerate necessary patience. You can't sit in a position that's doing nothing, even though consolidation before continuation is one of the most common patterns in trending markets. Your need for constant action, for stimulation, for feeling like you're actively trading, makes you exit positions right before they do what you wanted them to do. Do you see the pattern in all three barriers? None of them are about the strategy being wrong. None of them are about the market being against you. All three are about you not being able to tolerate normal, temporary discomfort that's required for long-term trend capture. Being early feels uncomfortable but gets you better prices. Profit erosion feels uncomfortable but is necessary to ride full trends. Boredom feels uncomfortable but is the price of patience that lets big moves develop. And this is why I'm telling you, the strategy almost doesn't matter, because until you develop the capacity to tolerate these three types of discomfort, every trend strategy will fail you in exactly the same way. You'll abandon it right before it would have worked. You'll override it at exactly the wrong moment. Not because the strategy failed, but because you couldn't execute it. So here's the commitment you must make if you want this to work. And I'm being completely serious. This is non-negotiable. You must commit to following this strategy for 100 trades without modification. Not 5 trades to see if you like it. Not until it has a losing month. 100 completed trades following the exact rules we discussed. No changes. No optimizations. No improvements. 100 trades. Why? Why such a specific number? Because trend strategies don't work on trade 5 or trade 15 or trade 27. They work across distributions, across enough trials that the mathematics can play out. You might have 20 winning trades, 50 break-even trades, 30 losing trades. And if you execute all 100 correctly, if you follow the system without emotional override, those 20 winners will be so much bigger than the 30 losers that you're profitable overall. That's how trend following works. Small, frequent losses, small, frequent break-evens, and occasional massive winners that make everything worthwhile. But if you abandon the strategy at trade 40 because you hit a drawdown period, if you quit because you had 5 losers in a row and decided it doesn't work, you never get to trade 62 and 79 and 93 where the big winners are. You never let the distribution play out. You're constantly sampling the beginning of strategies and never experiencing what happens when you commit to one long enough to see the full picture. Most traders spend their entire careers trying 10 trades of 20 different strategies. They test something, hit some normal losses, decide it doesn't work, move to the next thing. 10 trades there. Same cycle, different problems. Next strategy. They spend years collecting data on how the first 10 trades of various systems perform, but they never have data on what happens from trade 30 to trade 100 of a single system, and that's where the actual edge lives. The commitment principle is simple. Consistency over time beats optimization over variables. One simple strategy executed 100 times will teach you more and make you more money than 10 complex strategies abandoned at the first sign of difficulty. Because the learning isn't just about the market. The learning is about you, about your patterns, about when you override, about which barriers you struggle with most. And you can only learn that through repetition with the same system. Now here's a truth that's going to sound strange, but is absolutely critical to understand. You cannot control whether this specific trade wins. You literally cannot control it. The market will do what the market does. Your analysis might be perfect, and the trade might lose because of some random news event. Your analysis might be terrible, and the trade might win because of luck. You cannot control outcome on a trade-by-trade basis, but you can control whether you follow your process. You can control whether you enter at your signal, whether you place your stop where your strategy requires, whether you hold until your exit criteria are met. You can control execution, and most traders focus all their energy on what they cannot control, which is outcome, while ignoring what they can control, which is execution. When you make the mental shift from "I need this trade" to "win" to "I need to execute this trade correctly regardless of outcome," everything changes. Because now you're measuring success by something you actually control. You're not at the mercy of random market movement. You're evaluating yourself on process adherence. Did I enter at my signal? Yes. Did I place my stop where my strategy requires? Yes. Did I hold until my exit signal regardless of how uncomfortable it felt? Yes. Then that trade was successful, even if it lost money, even if it was stopped out, even if it was frustrating, because you executed correctly. You followed your process. And here's what happens when you string together 100 correctly executed trades. The money takes care of itself. The distribution plays out. The math works. But if you're executing incorrectly, if you're constantly overriding your system, exiting early, entering late, moving stops, you can't succeed even if you get lucky on a few trades, because luck doesn't compound. Process compounds. The paradox of control is this: the less you need each individual trade to win, the more your trading wins overall. Because you stop making emotional decisions based on fear of this trade losing. You start executing mechanical process. And mechanical process, over enough trials, produces the results that emotional trading never can. Let me talk about growth for a minute, because I think there's a fundamental misunderstanding about how accounts actually grow in trading. You don't grow your account by finding a better strategy. You grow it by executing your current strategy better. And better doesn't mean adding indicators or optimizing parameters or finding more sophisticated entry techniques. Better means reducing emotional interference. Better means following the system more consistently. Better means tolerating the discomfort more effectively. Every time you follow your strategy despite fear telling you to exit, you grow. Not just your account, but your capacity, your psychological capacity to execute under uncertainty. Every time you stay in a winning position despite the urge to take profit early, you grow. You're training your nervous system to tolerate temporary discomfort. Every time you take the pullback entry, even though it feels early and scary, you grow. You're proving to yourself that you can act on strategy rather than emotion. This growth is psychological, not technical. You're not learning better chart analysis. You're not discovering new indicators. You're developing emotional capacity. The capacity to sit in uncertainty without needing to act. The capacity to tolerate drawdown without panicking. The capacity to trust process over feeling. And that capacity, that psychological development, is what actually determines whether you succeed long term. And here's what's beautiful about this. Once you develop this capacity with one simple strategy, you have it forever. It transfers. You become someone who can follow a system, someone who can execute without emotional override, someone who can sit through discomfort for long-term gain. And that person, that trader, who's done the psychological work, can succeed with any reasonable strategy, any trend system, any approach that has positive expectancy. But someone who hasn't developed this capacity, who hasn't done the inner work, fails with every strategy. They fail with complex systems. They fail with simple systems. They fail with systems that have 90% win rates in backtests. Because the failure point isn't the system. It's the inability to execute it consistently. So let me make this completely practical. Let me give you the exact steps to implement this starting right now. Step 1. Choose your commitment. You're going to pick one time frame, either daily charts or weekly charts, not both. 1. Then you're going to set up the 50 and 200 period exponential moving averages on your charts. Then you're going to choose 5 assets that you'll trade this strategy on. Could be 5 stocks, could be 5 currency pairs, could be 5 futures contracts, 5 assets, not 50, not 500. 5. And then you're going to write this down on a piece of paper. I commit to 100 trades following this exact strategy without modification. And you're going to sign it, date it. Put it somewhere you'll see it every time you open your trading platform. This is your contract with yourself. This is your commitment to consistency over time. Step 2. Define your exact rules. Write these down word for word. Entry signal is price touching or approaching the 50 EMA when we're in an uptrend, which is defined as 50 EMA above 200 EMA. Stop loss goes below the most recent swing low before the entry. Exit happens when price closes below the 50 EMA or when price hits predetermined resistance where you're taking profit. No discretion. No unless it feels different this time. No except when the news says. The rules are the rules, because the moment you start adding exceptions, you're not testing the strategy anymore. You're testing your emotions. You're testing your ability to rationalize overrides, and that test you'll fail every time. Step 3. Track process, not profit. After every single trade, you're going to journal one thing, one simple question. Did I follow my rules? Yes or no? Not did I make money? Not did I feel good about the trade? Did you enter at your signal? Did you place your stop where your strategy required? Did you exit at your signal? If the answer is yes to all three, you mark that trade green in your journal, even if you lost money. If the answer is no to any of them, you mark it red even if you made money. You're training yourself to value execution over outcome. You're rewiring your brain to measure success by what you can control. And over time, over those 100 trades, you'll see a pattern. You'll see that the green trades, the ones where you followed process, produce better results than the red trades where you overrode the system even when you thought you had good reason. Step 4. The pullback journal. This is specific to barrier number 2, the profit erosion problem. Every single time you feel the urge to exit a winning position during a pullback, before you click that exit button, you write this down. I want to exit because I'm afraid of losing open profit. My strategy says hold until price closes below the 50 EMA. I'm choosing to follow my strategy instead of my fear. Just writing that down creates enough pause, enough space between impulse and action that the emotional override loses its power. You're acknowledging the fear. You're recognizing what's happening. And you're consciously choosing strategy over emotion. And the more times you do this, the more you make that conscious choice, the weaker the emotional override becomes. You're literally rewiring your automatic response. You're teaching your nervous system that the discomfort of profit pullback doesn't require action. It just requires patience. These 4 steps sound simple, and they are simple in concept. But simple doesn't mean easy. Because what this really requires, what all of this is actually asking of you, is that you become someone different. Someone who can tolerate what you currently can't tolerate. Someone who can sit in uncertainty when you currently need certainty. Someone who can follow process when you currently chase outcomes. And that transformation doesn't happen in 1 trade or 5 trades or 10 trades. It happens over 100 trades of consistent practice, of catching yourself about to override and choosing differently, of feeling the fear and acting according to strategy anyway, of tolerating the discomfort until it becomes normal. We started this video with a bold statement. Stop looking for a better trend strategy and start looking at why you can't follow the one you have. And now you understand what I meant. You've learned that the best trend traders use the simplest systems. Not because simple is magical, but because simplicity removes the hiding places. When the strategy is basic, moving average crossovers, when there's nothing complex to blame, your psychology is completely exposed. And that exposure, as uncomfortable as it is exactly what you need. You saw the 3 psychological barriers that destroy trend trading. You can't tolerate being early even though early entries get the best prices. You can't tolerate profit erosion during pullbacks, even though pullbacks are how trends breathe. And you can't tolerate boredom during consolidation, even though consolidation before continuation is one of the most reliable patterns. All three barriers are about emotional discomfort, not strategic flaws. And all three can be overcome not by finding a better strategy, but by developing greater capacity to tolerate temporary discomfort for long-term gain. That capacity is built through repetition, through 100 trades of choosing strategy over emotion, through 100 opportunities to catch yourself about to override and choosing differently. Most powerfully, you discovered that growth in trading doesn't come from finding better strategies. It comes from becoming better at executing the strategy you have. The growth is psychological. It's about becoming someone who values process over outcome, who measures success by execution rather than profit, who can sit in uncertainty without needing to act. Now listen to this truth and really let it sink in. You don't need a better strategy. You need to become a better executor of the strategy you have. The trend doesn't fail you. Your inability to stay on the wave, to ride the movement without jumping off every time you feel uncertain, that's what fails you. But here's the good news. That's trainable. Tolerance is trainable. Commitment is trainable. Execution is trainable. You're not broken. You haven't failed. You've just been optimizing the wrong variable. You've been looking for better tools when you needed to become a better craftsman. The only trend strategy you'll ever need isn't a strategy at all in the traditional sense. It's a commitment to simplicity over complexity, a commitment to consistency over optimization, a commitment to 100 trades of following a basic system without emotional interference. It's choosing the 50 and 200 EMA crossover or any simple trend system and proving to yourself that you can follow it despite fear, despite boredom, despite the constant urge to optimize or switch or override. And when you do that, when you complete 100 trades following simple rules without letting your emotions sabotage the process, you won't just have profits. Although you will have those if you execute correctly. You'll have something much more valuable. You'll have become someone different. Someone who can sit in uncertainty without panicking. Someone who can tolerate temporary discomfort for long-term gain. Someone who can ride trends instead of jumping off waves. Someone who can execute process without needing immediate emotional reward. That person succeeds in trading. That person grows accounts. Not because they found some secret strategy that nobody else knows, but because they developed the psychological capacity to execute a basic strategy that everyone knows but almost nobody can follow consistently. So if this reframed trend trading for you, if you finally see that the problem isn't your strategy but your execution of it, I want you to share in the comments which of the three barriers you struggle with most. Is it being early and sitting through initial drawdown? Is it profit erosion during pullbacks where you want to lock in gains? Or is it boredom during consolidation when nothing's happening? Share that, because naming it is the first step to overcoming it. And your honesty might help someone else recognize their own pattern. Like this video, if it showed you that complexity in trading is often a hiding place rather than an edge. If it revealed that simple systems expose your psychology in ways that complex systems mask. If it helped you see that the work isn't finding better tools, but becoming better at using basic tools. And subscribe to this channel if you want more psychological truth about what actually makes traders successful versus what gets marketed as the path to success. Because I'm going to keep sharing this perspective. The uncomfortable truth that the problem is usually internal, not external, that the work is psychological, not technical, that success comes from execution, not optimization. And remember this as you go back to your charts, 100 trades, one simple strategy, the 50 and 200 EMA system, or any basic trend approach you choose. No modifications for 100 trades. That's the only trend strategy you'll ever need. Not because it's perfect, not because it wins every time, but because committing to it for 100 trades makes you someone who can finally execute without sabotage, someone who can follow process, someone who can stay on the wave. And that person, that trader who's developed psychological capacity through committed repetition, that person can succeed with any reasonable strategy. But without that capacity, without that inner development, you'll fail with every strategy, no matter how sophisticated. See you in the next one. Stay on the wave.